All right, so before we get going here, the Canvas downtime yesterday was unexpected. If I should have sent an email out to everyone, you should have seen it come through. I did it through like the SIS system, but it should have came to your email. I'm pushing the due date for that Module 9 reading and then that Module 8 quiz to be the end of the day today instead. So if you lost yesterday and we're planning on doing that from any time to like 8 to 8 yesterday, it was down. Obviously, you couldn't do that. And so I pushed the due date to be the end of the day today. So if you didn't do that module quiz or that module 8 quiz, module 9 reading, you'll have to the end of the day to get on and complete those, and they'll still be counted as on time. Okay. If you already submitted them, no issue. Okay. So we've kind of got those updates along with all the Module 9 material. So I think I sent a link out as well, just because I wasn't sure if we'd have Canvas up today or not, so you could follow along. So I have like a SharePoint link that I sent to you. I guess now we don't really have to worry about it because all the materials are still now viewable and accessible on Canvas. Okay. I've also got kind of where we're at in the class. We had that, excuse me, third Canvas discussion, which is due at the end of the day, Friday this week. So you should see your kind of Canvas discussion 2 grade pop up later today. I've had my GAs kind of help me grade those. I'll make them viewable to you after class today, but you've got that third one that's due at the end of the week, okay? After Thursday's class, what will pop up on Canvas? The module, what module are we covering this week? Module 9 quiz, but there won't be a module kind of 10 reading because next week is what? The second midterm, right? So we don't have any new material next week, right? This is where we're going to have a review session basically on Tuesday in class. Okay, well, we'll get this fixed. Hopefully, there we go. So we'll have a review session in class Tuesday, and then we'll have that in-class exam on Thursday. So I'll get more information out about that later in the week and have more to talk about on that on Thursday's class, but it'll look really similar to that first midterm, okay? Other than that, I've got that practice exam. You can kind of, that's been out since last Thursday, so you can start kind of working through those problems. We haven't covered module 9 yet, but after this week, you should be able to kind of answer every single question that's in that practice exam, okay? Excuse me. Any other questions for me before we get going here? One thing I did want to also mention, I mentioned this in class, but I've had some people ask me some questions about it. I did put up an additional video on subsidies specifically, kind of working through an example showing how producer and consumer surplus increase, but we have government expenditure. So I just kind of went into a little bit more in-depth into that, just a different way of looking at it. Probably more in-depth than you would even need to answer some of these questions that are going to come up on the exam. But if you are kind of struggling with subsidies, that might be a good video to kind of go on and watch. I think it's like 12, 13 minutes long. So that's just on the YouTube playlist where I'm putting all the kind of class recordings as well, okay? Other than that, we should be getting good to go to jump into Module 9. So there's some stuff we didn't quite get through in Module 8. I'm going to hold off on that. We might look at it at the end of class today, or I might start out with it on Thursday. We'll just kind of see how class goes today. But the end of those slides where we're talking about Giffen goods and thinking a little bit more about income substitution effects, we'll revisit that for sure, whether it's today or on Thursday's class. I put one of the quiz questions. I give you the answer in the last question because I didn't think we spent quite enough time. You probably could still answer it based off what we talked about, but I want to go through it a little bit more. And so I gave you kind of the answer in the question. So hopefully everybody got question 12 correct. I bolded it and told you what the answer was, okay? All right, so I also put up a little Excel file that we might take a look at today. I'll kind of use it in the slides, but we'll kind of show you an Excel file just to kind of get used to looking at data a little bit more. That's kind of what these Canvas discussions for a little bit, kind of playing around with some of those tables and the data that exists. So I'm going to try to start sprinkling in a little more data towards the end of this class. So we've got an Excel file that we'll take a look at this week as well, okay? I'm not going to expect you to do anything in Excel, but I'm just kind of showing you, as additional kind of proof for some of the things that we're talking about, okay? All right. Any questions before we kind of dive into things here? All right. Also, if I ignored your email yesterday, about Canvas, I'm probably not going to get a response because I had about 40 or 50 emails. So I read them quickly. If I didn't respond to you individually, it's because I tried to send out a mass email. I knew Canvas was down. I was kind of waiting to see how quickly it would come back. Okay. So we are going to kind of switch gears this week from last week. We were talking more about the consumers, right? Consumer optimums. We were talking about indifference curves, utility represented consumers' happiness, right? Or kind of their benefit. Now we're going to be thinking about things in the context of companies or producers, okay? So when we think about firms' costs, we're going to have two different types of costs we talk about. The first is explicit, and the second is implicit costs. So explicit costs are generally the kind of costs you would think about, something that you're handing over money for, right? So if a company is paying for raw materials, right? I don't know, iron to make something, or if they're paying their workers, right? Those are production costs. They actually have to hand money over for those, right? Excuse me. Implicit costs are going to be very similar to something we've already talked about, which is opportunity costs, right? So when I choose to do something, what am I foregoing? Those are going to be my implicit costs, okay? So I'm not actually handing money over for them. It's just that I'm using my time, right, and my money to do something. What am I not doing with that time and money? That's my implicit cost, okay? So we'll kind of put this in a slightly different context to start out. Not quite producers, so we can think about implicit costs, how they kind of connect with your everyday life, but then we'll kind of switch very quickly to producers, and then total costs are just the sum of those two, right? Just implicit plus explicit, okay? So we'll kind of set this up with an example, thinking about implicit and explicit costs, and thinking about the returns to education, okay? So I wrote down some numbers to make this specific to you guys, so it might have a little more context, right? So let's say, I don't know, for the sake of this example, that my wages, if I don't get a college degree, are $40,000. My wages, if I get a college degree, bump up to 60. Hopefully more than that, but we're just using some kind of nice numbers to work with here, okay? So if I think about the implicit and explicit costs that exist for you guys attending college, right? Why are you here? Because you think that once you're done, you're going to be able to make more money, right? Or do something that you enjoy. So we'll just talk about it in terms of money here. So if I think about, let's just say I work for 20 years, right? And let's say that every year I attend IU. I kind of looked this up this morning. I think this is like room and board and tuition for in-state, and I'm rounding it quite a bit. I think it's actually a little bit higher than this. But let's say it's $25,000 a year that it costs you to be here. Right? So if we're thinking about the total returns to education, right? If I'm going to work for the next 20 years, what's the additional benefit I'm getting? Well, every year, once I graduate, how much more money am I making each year? $20,000. Now, hopefully that increases, but just to kind of keep it nice and linear here, we'll say $20,000 a year. So if I take that $20,000, multiply that by working for the next 20 years, I've got kind of my total benefit, right, over that time is $400,000. Now, what is the explicit cost of attending for a 4-year degree? Well, if every year it's $25,000, for a 4-year degree, how much is that going to cost me? 4 times 25,000 or $100,000. So we're going to put this in the context of producers here in a second. But if we think about accounting profits, and this is kind of weird here to think about this in the context of attending college, but my accounting profits only take into consideration my explicit costs, right? So the actual money I was handing over to attend university. So here, my benefit is going to be, I'm making additional $400,000 over the next 20 years. I had to spend $100,000 to do it. So my accounting profits as a student, right, would be, I made, net benefit of $300,000. Right? That was my profit as a student. Right? However, what was my implicit costs for attending college here? Well, if I'm attending 4 years, let's just assume I don't have time to work a full-time job. If I'm not working, how much money am I foregoing each one of those years? How much money could I have made working, I don't know, maybe I'm working construction or something, putting in 40 hours a week, I could have made $40,000 each year. So my implicit costs or by taking my time to go to college, I was giving up $40,000 every single year. So my implicit costs are actually pretty high, right? So we'll then kind of start to talk about firms, but you can think about in the context of a student, what are my what are my economic profits here? Well, my economic profits take into consideration both my explicit, but also my implicit costs. So for the student, your economic profits, well, you're still making $400,000 over the next 20 years or your lifetime of working. You paid $100,000 to get that degree, but you also didn't work for those 4 years, right? So what? If I'm doing math in my head correct here, right? Your economic profits are actually quite a bit lower than your accounting profits. In fact, here they're almost, what, half as much, right? So you can kind of just see here, if you take into consideration those implicit costs, the value of that degree changed quite a bit. It fell in half, right? So what happens, let's say, I don't know, my dad owns a company, right, and can give me a job without a college degree. What happens to my implicit costs? Well, maybe instead of making $40,000, I could actually make quite a bit more, right, because I kind of have this connection. What happens to my implicit costs? Well, if I go to college, I'm now not working for the family business making, I don't know, maybe $80,000 a year. This would increase quite a bit. At some point, what could happen to the economic profits of attending university? They could become negative, right? So if we don't take into consideration those implicit costs, it always looks like the returns would be positive. But once we start to take into consideration those implicit costs, it can change what those profits are or what the return to education is by quite a bit, right? So this is just kind of putting in the context of what you're thinking about making decisions. You should be taking into consideration both your explicit, how much tuition costs, or room and board, but also your implicit costs. What are you not doing for the 4 years that you were here, right? So companies have the same decision, right? So when we're thinking about what kind of profits do companies want to maximize, do they want to maximize accounting or economic profits? Economic profits, right? They want to take in consideration all these things they're not doing. And for them, it looks a little bit different, right? Maybe instead of producing widgets or whatever good we're looking at, maybe they could have been taking that money, investing it into the stock market, and maybe that's their implicit costs. So when times are good, instead of ramping up production, what might I want to do as a company? Well, if I can make a lot of money by investing in the stock market, maybe instead of kind of operating, producing more units, I might actually want to take that money, put it towards something that has a high return on investment, right? Because if I don't, then I have a really high implicit cost by not taking those resources, putting it towards something that I, would be making a lot of. So there's always going to be this kind of trade-off, right, between improving, right, what looks like our accounting profits. If we don't take into consideration those implicit costs, I might be making an incorrect decision. I shouldn't be trying to maximize accounting profits. I should always trying to be maximizing my economic profits, taking into consideration all costs, okay? So when we put this in the context, I think I had some numbers here that, were a little bit more precise. I didn't round them to be kind of nice and easy, but we would kind of have the, we could work through a model just changing the numbers a little bit with the same kind of idea, right? So I think I rounded 40 to 40,000, kind of thought about 25,000 as opposed to the 28,000, but it's the same sort of idea, okay? So the firm is going to do the same thing, right? They're going to try to maximize these profits, but we said not just accounting profits, they want to maximize their economic profits, right? Taking into consideration all types of costs, okay? So really the only difference between these is that the economic profits, it's the same equation, but we also factor in the implicit costs. So nothing too crazy here, right? So with this idea in mind, if I have maybe this in the context of more of a producer, let's say someone is thinking about starting their own restaurant, right? So they start this restaurant, I don't know, maybe this is annually, they can make $500,000 in Indianapolis, but they've got a bunch of explicit costs, right? They got to pay their workers, they've got to pay for the raw materials, the actual food, right, to serve to people. And I've got what? Rent for the building, machinery that you might need for the kitchen. We would add up all these explicit costs, right? Here, okay, my accounting profits, if I just take the total revenue I'd be earning minus my total explicit cost, it looks like I'd be making $100,000 here. That's pretty good, right? So this person might be like, I should open up my own restaurant, right? But if they don't take into consideration implicit costs, if they're a really good chef, maybe they could work for another company making $150,000 a year. Well, if I own my own restaurant and I was just making $100,000, but if I worked for someone else, I could make $150,000. If we just assume that all this person cares about is maximizing dollars, right? We don't factor in like happiness or anything like that. What should they choose to do? Is $150,000 better than 100? Yeah, right? So if we're thinking about what they're foregoing, if that was ever larger than their accounting profits, then their economic profits, if they choose, right, to open their own restaurant, would actually be, we factor those implicit costs in, negative. So are they maximizing economic profits by opening up their own restaurant? No, they'd be $50,000 in the hole. They'd actually be $50,000 better off if they worked for someone else, right? And that's because the amount of money, what they're foregoing, is so high, right? Same kind of idea. If you can work for, your dad or mom at their company, start out without a college degree, making a bunch of money, it doesn't make as much sense for you to go out and get a college degree. Same kind of idea here. Okay? So when we factor in these implicit costs, right, the total economic costs, explicit plus implicit, we might actually make a very different decision, right? So here we shouldn't open our own restaurant because I'd actually be worse off. So these are just kind of our initial examples, thinking about implicit, explicit costs and how the optimal decision of the producer could change if we don't factor in these implicit costs. Okay? I went through it kind of quick. Any questions on this idea? Okay, so let's think about if we have a second example. Before we even work through the numbers, let's say instead, if I'm working for someone else, I can't make 150. Maybe I don't live in Indianapolis. I'm thinking about opening a restaurant in, I don't know, I'll pick on a Spencer, Indiana. If you don't know where that's at, it's a little small town south of here, right? Well, I'm probably not making $150,000 as a chef in that town, right? Maybe I'm only making 50, right? Well, what's going to happen? Is it going to be more or less likely I want to open my own restaurant if my implicit costs, what I'm foregoing, are now much lower? Should it be more or less likely I want to open my own restaurant? More, right? And if I factor those in, my total revenue hasn't changed from opening this restaurant. My explicit costs haven't changed. The only thing that's changed is my implicit costs. So now instead of subtracting $150,000 to calculate economic profits, I'm only subtracting 50 here. And maybe I add this in, I'll talk about this in a second. Let's ignore it for a second. I'd only be at 50,000, right? Now, maybe there's also, right, it's not that we only have one type of implicit costs. So in this example, I'm going to build in a separate type, right? If I didn't take all that money to put towards machinery, my workers, maybe I could have put it into mutual funds, which are going to then pay me a certain amount of money over the course of a year, right? I'm going to have a return on that investment. So by taking all that money to start my own business, not only am I foregoing working as a chef somewhere else, I'm foregoing all that money that could have been made from the money I had to put into machinery, my workers. So maybe I also have this implicit cost of I'm also not making $10,000 in these mutual funds, right? And if times are good, what happens to that implicit cost? If times are good, mutual funds will return larger amounts of money, right? So what are people more, it kind of seems counterintuitive, but if the stock market is doing good, is it actually going to be more or less profitable for people to start their own business? Less, right? Because they can take that same amount of money that would go into that business and make a lot more money by taking it and putting it into things like mutual funds or investing into rental properties, whatever it is. Okay. So this is kind of our just way of starting to think about these implicit, explicit costs and how it can change our decision making. We're also going to talk about a type of cost that doesn't really get factored into our decision making. We'll talk about why. So this is the idea of a sunk cost, right? So a sunk cost is going to be something I have to pay no matter what I do, right? So no matter what I do with my time or my money, I'm going to have to pay this cost regardless. So if my decision doesn't change whether or not I have to pay this cost, then it shouldn't be factored into my decision making, right? So we can kind of work through some examples here. Excuse me, but it kind of goes along with this, term or phrase you might have heard. There's no use crying over spilt milk, right? If I've got to pay this cost no matter what, it shouldn't impact my decision-making moving forward, right? So here we'll think about an kind of toy example, not quite in terms of a producer, But let's say, I don't know, you're going to go to a movie. I know it costs more than, I don't even know what a movie, I haven't been to a movie in over a decade probably. Actually, I lied. I went to the Taylor Swift thing with my wife when that movie was out. But I have no idea. Let's just say a movie ticket costs $10, right? Just have a nice, easy number. If I decide to go to the movie, it must have been that the total benefit to me would have been greater than that total cost, right? Well, if I'm on my way to the theater and I realize, okay, I lost the $10 that I was going to spend. Well, if I'm making the decision on whether or not I go to the movie, what's happened to the marginal benefit of attending the movie? It's still whatever it was before. What is my cost going to be? Not my total cost, but what's my marginal cost if I choose to go to the movie now? I lost that $10 if I choose to go or not, right? So if I don't go, my marginal cost is 0. What is my marginal cost if I now choose to go? Still $10. So if my marginal benefit was greater than that marginal cost of $10 before, it still is, right? So we don't look at the total cost, right? You can think about the total cost as I have to pay another $10 and I lost 10, but we make decisions on the margin, right? So these sunk costs, because they're not changing depending on what I do, they never get factored in or they're never in my marginal costs, right? So same decision I should make before. The marginal benefits and the marginal costs haven't changed. Same kind of thing. If I buy the ticket and then I lose it, well, if I don't go to the movie, you can kind of think about it as what's my loss there? I lost $10. If I choose to go, what must have been true if I made the purchase the first time? The marginal benefit must have been greater than the marginal cost of 10. So now if I go, I've still lost $10, but at least that net benefit by going is going to be some positive amount. So my total loss would be something a little bit less than 10, right? So it doesn't matter, right? If we have this cost that doesn't change with my decision, then it won't get calculated into my marginal cost, and we make decisions on the margin. So it doesn't matter, kind of the same idea with a company, right? If let's say I get this huge lawsuit, right, and I have to pay a couple $100,000, should I stay open or not? Well, if I was going to remain open before, have the marginal cost of staying open changed at all? No, I've got to pay those, got to pay those legal debts either way. So my total cost will be higher, but my marginal costs are exactly the same, right? So whenever we have these huge costs that might impact companies, but they're going to be the same no matter if they decide to stay open or not, we might actually see companies, right, or we should see companies ignoring that, okay? So what do we say to the sunk cost fallacy? The sunk cost fallacy says we actually take into consideration the sunk cost. Well, if you do that, you're going to be making suboptimal decisions, right? This would be the idea. Let's say I have to pay these legal fees and they're $100,000. Well, if I don't remain open, what are my economic profits? Well, I'm making no revenue. I have no explicit costs, but I still have this huge legal fee I have to pay of $100,000, so I'm negative $100,000. If I stay open, maybe I can make $100,000 over the next year. Well, if I've made kind of my accounting profits of 100,000, I have this huge legal fee of 100. What would my profits be there? 0. 0 is better than negative 100, right? So we should be ignoring these sunk costs when it comes to our decision making, okay? So these are all the kind of different types of costs we're going to think about. We're now going to dive a little bit more into, okay, now that we know we should factor in implicit costs and ignore these sunk costs, how do firms actually make their production decisions, okay? So we're going to talk about kind of the long run and the short run. So we'll really just focus today on the short run. So in the long run, we can change everything, right? I can build a new production facility to lower my costs, right? Or I can, hire more experienced CEOs or something like that, right? But, to build a new production facility isn't something I can change overnight, right? It takes some time. So that's how we think about it as the long run. Now, things that we can always do in the short run, which is why that's the examples that I will give you. What's one thing a company can always do minute to minute if they really want to? They can always hire and fire workers, right? We're going to assume there's enough workers out there that want to work. I think that's not a wild assumption, right? There's usually people who are willing to fill positions. And so I can hire and fire workers, or I can change my labor day to day. So we're always going to think about that as the short run. I can change that minute to minute. some things like building new production facilities, even if I want to change them, it's going to take a longer period of time. So we're just going to focus on the short run today and the types of costs that we can change overnight, very quickly. Okay? When it comes to investing in new machinery, new production facilities, so we kind of think about capital. Capital is like machinery that we're going to need to produce different products. That might take more time. Okay? So we're just going to focus on the short run and thinking about hiring and firing workers or changing our labor costs. Okay? So, excuse me. So we're going to start thinking about these firms really have a production function. Okay? As they hire more workers, so a production function tells us the output that we're going to get when we put more money into one of these types of like factors of production. So generally we break them down to be like labor, maybe like capital, machinery. We think about land, the land I need to build a production facility, actually have my business. We're going to think about how does the choice of labor or the input of labor change my output? Well, if I hire more workers, can I get more or less output than before? More, right? But what happens as I hire workers? Who do I hire first? The most effective or the best worker. Well, then who do I hire second? The next best, and the next best, and the next best, right? So we have this kind of positive relationship between this factor of production or this input, specifically the quantity of labor. If it helps, you can think about this as the number of workers. You could also break this down and think about maybe I don't even hire more workers, but I make them work more hours, right? So the quantity of labor, I always kind of talk about it in terms of like the number of workers because I think that's a little bit easier to think about, but it could be the number of labor hours if we wanted to be a little bit more precise, right? But for anything we'll do in this class, you can think about it as the number of workers. I think it's a little bit easier, right? So as I hire more workers, what did we say? The output I can get is going up. So what's true about the slope of my production function? It is positive. However, when I hire that first worker, they're going to add, they're very effective, so they're going to add a lot of output. But that second worker, well, they were the second best. They're still going to add output to my company, but maybe not quite as much as the first. And then the third and the fourth, etc. I start to hire less and less productive workers. So I've got this positive slope, but what's happening? The additional output I'm getting per worker, because I'm hiring less and less effective workers, is going down. Or I have an increasing excuse me, how am I thinking about my output here? It's increasing, but what does the slope tell me? It tells me the rate at which it's changing. So it's increasing at a decreasing rate, right? So my we talked about the per worker production function back in like module 2. We said that we're getting more and more output, but the marginal output I'm getting as I hire more workers is actually going down, right? I could even think about this. I think I'm jumping the gun a little bit, but here, if I've got my quantity of labor, I've got my output here. Here's my production function. If I wanted to look at those different number of workers or my quantity of labor, what's happening to the marginal output I'm getting per worker? It's going down. So if I wanted to look at my marginal output or the change in that output, that would be the slope. Initially, the slope is relatively high. And as I hire more and more workers, that slope or the marginal output I'm getting is going down. So when we think about the marginal product of labor or the marginal output we're getting per worker, it is decreasing. Okay? And we can exactly kind of map that out, right? This is really just telling me the slope of my production function. Okay? So once again, jumping the gun a little bit here, but I think having this context when we talk about things a little more detail, this might help. What is the marginal output to a firm? When I have more units, that means I can sell more, right? So what is that going to do to my total revenues? Increase it. So I could almost think about every unit I have, what's the marginal revenue? Well, it's however much I can sell it for. That would be when I sell something, I'm selling it for the price of that good. So my price is essentially my marginal revenue, right? I can think of the marginal output. I could just equate that to dollars by taking the marginal output and simply multiplying it by the price. So I could think about, in some ways, this is going to represent, if I wanted marginal revenue, it would just be the marginal product times the price. So that would just kind of change the values here, but I'd still have that same slope. What do I want to compare that to? If the marginal revenue I'm getting by hiring that worker, I want it to be greater than the what? Marginal cost. What's the marginal cost of a worker? What do I pay workers? If it's hourly or even over the course of a year, I pay them a wage, right? So I could think about, there is some market equilibrium wage that I have to hire workers no matter what sector I'm in. So how many workers do I want to hire? As long as the additional revenue they can bring into my company is greater than the additional cost, right? Wages essentially represent the company's marginal cost in the short run. So here, every worker up to this point, are they adding to my economic profits? Well, if the marginal revenue or the benefit to the company is greater than the marginal cost, yes. So every worker here, we could kind of think about, this would be like I use star here. I could think about, well, up to the point where those are equal, that's my equilibrium number of workers. Any worker past that point, what's true about my marginal cost relative to the marginal benefit to the company? We'll just put this in a slightly different context. The marginal benefit to the company is the marginal revenue they're earning, right? So just like marginal utility was the marginal benefit of the consumer, marginal revenue is the marginal benefit to the producer. Every worker here, that marginal cost is greater than the marginal revenue. So do I want to hire any worker here? No, I stop right here. Right? So it's really the same kind of decisions that we've had before. It's just in a slightly different context. We're now putting in the context of a firm making that decision of hiring or firing workers, or how many workers we should hire. Okay? Any questions here? So we'll go into this a little more in depth, but I think having like a big picture sometimes helps before we break it down to be a little more precise. Okay? So sometimes you'll see this written. In the short run, I always use labor, but technically you can change capital too. Like machinery could be relatively quick, right? I could get, if I'm thinking about my example of opening like a restaurant, I could probably get the tools required to run a restaurant overnight, right? And so maybe capital, some of these things that we're investing that we're giving our workers to produce things, maybe that can be something that's changed in the short run as well. We'll just focus on labor though. So here's my output. It's a function of the capital or the machinery I'm giving my workers and the number of workers I hire. Right? So, excuse me. I'll use Chipotle here. I think that's my example that I have. We'll think about their decision in the short run. Okay. So if I think about the number of workers they're hiring, right? That first worker, well, I go from not being able to produce anything to like, okay, they've got to take the order, they got to build your burrito bowl, they got to check you out. But if I've hired the best worker first, they're going to go through that relatively quick, right? So maybe that first worker, right, adds a pretty good amount of output to my company. Now, when I hire the second worker, right, they weren't as good as the first, otherwise I would have hired them first, right? But once I hire them, what can I start to do? Well, now one of them takes the order, one of them focuses on kind of building, and then maybe the other one, I don't know, goes to check people out real quick, and they kind of, I get a little bit more of what we would call specialization. Right? So as I hire more workers, because I'm hiring less and less effective workers, well, each worker is actually going to provide less change in my total output than the one before. Okay? So I don't know, I've got a bunch of different numbers here. But ultimately, because I'm hiring less and less effective workers, yes, my output is still going up. When I'm hiring more workers to be behind that counter, I can now sell more burritos and burrito bowls throughout the day. But every worker I hire was a little bit less effective. So what's happening to the change in my total output? Well, here I kind of kept the numbers nice and easy because I was, oh my God. So I was always hiring one more worker. You gotta watch what I'm doing. So what was my change in output from hiring each additional worker? Well, the change in output from for that first worker, I was going from 0 to 1,000. How many workers did I hire? I went from 0 to 1. So the change in output over the change in the number of workers, that's my marginal product of labor. Now here, like I said, the change in the workers is always 1. So all I really have to do is look at my change in output. So notice initially, my change in output is 1,000, then it's 800, then it's 600, then 400, then 200. So if I'm looking at my marginal product of labor, we said that should be going down. And in fact, right, how do I calculate that? It's simply the change in output over the change in the number of workers I'm hiring. Okay? So anytime we want marginal anything, it's the change in that thing, the change in output from a change in my decision making. Here, our decision is to hire an additional worker. Now, our jumps in labor won't always be 1. We'll look at an example in a second where it's not, but it doesn't change how we calculate it. So if I keep it nice and easy and I just have a change of 1, here I said, what's my marginal product of labor? Well, for the first worker, it will be 1,000 over 1. And then 800 over 1. 600 over 1, etc. Right? So what's happening to our marginal product of labor as we hire more workers? It is decreasing. Right? Everybody with me on that before I make it more complicated? Okay? Let's say instead that in order to get an additional 1,000, maybe I'm thinking not over like the course of a day, maybe I'm thinking about the course of a week, or maybe I'm hiring 10 more workers over the course of that week, right? So now I'm having the same output, just to kind of keep it easy to think about with our last example. But in order to get that output, I now have to hire, I'm looking at jumps of 10, right? So to go from 0 to 1,000 burritos, I need to hire 10 more workers. What's going to happen to my marginal product of labor at every single point here? Well, if the change in output is the same, my numerator would be the same value. But now instead of dividing by a change in labor of 1, I'm dividing by a change in labor of 10. My marginal product at every point should be lower. Right? So if we go back to that marginal product of labor, it's the change in output I'm getting from a change in that factor of production or the number of workers. That number of worker change is no longer 1, it's now 10. So my denominator is larger. My marginal product before was what? 1,000, 800, 600, etc. Now when I calculate this, 100 over 10 would be 100. 800 over 10 would be 80, so on and so forth. My marginal product of labor is still decreasing, but because I had to hire more workers to get that same change in output, right, all those values are going to be a little bit lower. So, this is just kind of putting different numbers. There won't always be nice, easy changes of 1, right? Our denominator won't always be 1 is what I'm kind of making the point here. Okay? Any questions on this idea? Okay. I've got an additional example. I probably won't kind of waste time on this, but if I'm trying to, people I've been reaching out and they want additional problems, things like that. I'm giving you a practice exam. You'll have all those practice problems. You have the quizzes for every module. If you can work through all of those and provide a solution with a graph or an equation that proves why the answer is what it is for all of those, you've put in a lot of time, right? So if you're just wanting additional problems to work through, I understand, but it's not always more is better, right? Sometimes focusing in on a smaller set of questions and doing what we call increasing your intensive margin of understanding as opposed to the extensive margin of just having more questions is going to be more beneficial. So I try to throw in some additional examples here that we might not go through in class. If you want to work through these, it's something very similar to what we just did. It just has different values, right? So if I wanted to know the marginal product of the 5th worker here, what would I do? I would take the change in my output and I would divide it by the change in the number of workers. Here I have an easy example because the change in the number of workers is what? 1. So what's the change going from that 4th to the 5th worker? My output goes up by 11. Divide that by the change in the number of workers, which was 1. I would have my marginal product of labor is simply 11 here. Okay. So hopefully this marginal product of labor calculation is kind of making sense to us. We'll then want to think about, right, that we said, kind of connected to that graph I already drew for you, but my marginal product of labor should be decreasing. That represented the slope of my production function. okay? So if I'm thinking about, here's my production function, I put the actual values here to it. What was happening to the slope? It's getting flatter or steeper? Flatter, which means if this is my output, the slope represents the change in output or my marginal output. So if the slope is getting flatter, my marginal output is getting lower. So if I graphed out those marginal output values, skip ahead here. Oh, where did I have it? Well, I already kind of drew it for us earlier. I guess I didn't have an additional drawing in here. But right, we said as I hire more workers, what was happening to my marginal product of labor? It was decreasing. Right? That was that general idea. Okay. So now we're going to complicate it a little bit. Okay. Because even though the marginal product of labor, this idea that it should be decreasing, I think kind of intuitively makes sense because I'm hiring less and less efficient workers. But with my Chipotle example, I kind of already gave a little bit of insight into this. But if I go from hiring the first worker to the second, what can I have my workers start to do? Well, now maybe one worker is only running the cash register, the register, and the other person is just building the burritos. And then as I hire a third worker, well, maybe one person is doing like the first half of building it, handing it over to do all the toppings to the next worker, and then I still have one person just running the register. So each person is focusing on one task. They can become really good at that task. So as initially when I hire more workers, we say each worker can specialize in what they're doing. If I can specialize in just one thing, am I going to become better or worse at it? Better. So what if I can have my workers specialize, the effectiveness of every worker should increase. So even though I'm hiring the best worker first, they're running around like a chicken with their head cut off trying to do the entire Chipotle line. As soon as I hire a second, I can now have my workers kind of just focus on specific tasks. So what we're going to see is that initially, as I hire, there we go, more workers. So if I'm thinking still my decision of how many workers do I hire, if I'm graphing out the marginal product of labor, it may not always be decreasing. Because initially, when I only had one worker, yes, they were very effective, but they couldn't specialize in any one task. As soon as I hire the second worker, even though they weren't as effective as the first, because they're now both specializing on a task, maybe that first worker becomes even more productive than they were before. So now what's kind of my average productivity between the two workers, or what's the marginal product that adding that second worker had? It may now not be lower, it may now actually be a little bit higher. Because I now have not just this diminishing returns to labor, I also have this gains from specialization. And if the gains from specialization overshadow or are greater than that diminishing returns from hiring less and less effective workers, maybe initially when I hire more workers, my marginal productivity of labor curve is actually increasing. So we'll think about for companies, if I ever see my marginal productivity of labor curve is increasing as I hire more workers, we would call that I'm getting gains from specialization. Okay? I assume that there's probably examples that make sense with the factor of production of like machinery. If I can like pre-program one machine to just produce, I don't know if I'm building cars, maybe one machine is like, I don't understand enough of it, but like the CNC machines, I just have it just, if you don't know what that is, they're like these huge machines that like cut steel and things, like just make the struts for a car. Or then maybe, another machine, CNC, it's just pre-programmed to just make, I don't know, the hood or whatever it is. So there's probably specialization we could see outside of labor as well, but labor makes the most sense, right? And my Chipotle example, I think kind of hopefully is something you would maybe see every day if you don't go to Chipotle. Think about any restaurant, right, where you're going in and ordering something, where they can then kind of have a worker specialize at one part of that like production process, right? So if I ever see that marginal productive labor going up, I've got gains from specialization, right? Now, eventually, as I start hiring more workers, yes, I'm having more people specialize at their tasks, but use my Chipotle example. If I've got 8 people behind the counter, as I start to hire more people, what do they start doing? Just getting in the way, right? So eventually that I'm hiring less and less effective workers. I exhaust all my gains from specialization. Maybe there's only 4 tasks. So if I hire a 5th worker, there's no more gains from specialization. I've already specialized my workers as much as possible. So then what happens as soon as I exhaust those gains from specialization? Diminishing returns kind of takes over, right? So as soon as I start to see that marginal productivity of labor start to decrease, I know that I've exhausted all of the gains from specialization, and I'm just going to be on the same thing we were on before, which is the diminishing kind of returns to labor portion of that marginal product of labor. Any questions on this idea? Yep. I mean, for the sake of what we're going to be doing, I would always think about it as that initial portion. I'm sure there is an example where we could come up with a crazy production function where it like dips and goes back up or something. But 99.9% of the examples that we would see in actual production processes, you're always going to get your specialization first, right? Because why would you hold off on having your workers specialize, right? It just wouldn't make any sense, right? If I could, when am I going to want them to specialize? Right away, right? So we should always see those initial kind of increases in workers or labor. That should always be where we see that gains from specialization happening, right? It's a good question, though. Any other questions on this before we keep moving here? Okay. All right. So, excuse me. I kind of already had kind of set up my Chipotle example to think about this. And then I kind of drew this out for you where we said initially, I might see this gains from specialization portion, but over time, I'm going to exhaust those gains and I'll be back on that diminishing returns portion anyways. Okay. I don't know, the idea here is if I've got too many cooks in the kitchen, right, they just start decreasing the marginal product. Where do firms like to be? They like their workers to become more effective. So we like being on that gains from specialization portion, but we know if I want to ramp up my output, to get more output, I'm going to have to hire more workers. So eventually I will see this curve start to decrease again, right? And then it goes back to the same decision that we had before. It just looks a little bit more complicated. So if I had an example where there are no gains from specialization, which there's some production processes where that might be the case, right? If there's only one type of task I'm hiring people to do, I don't have any specialization. So I might just have a curve that looks like this. But if I think about one that does have gains from specialization, where would that wage be? Well, now it's really the same decision. Is that marginal product of labor, and I would multiply it by the price to get the marginal revenue. If it's greater than the wage, I'm going to hire every worker here. And what I'll see is that optimal number, or we can think about it, that equilibrium number of workers is still always going to end up on that diminishing portion of our returns, on the diminishing returns portion of our marginal product of labor curve. Right? So in the end, it's not going to look any different when we start to identify what's the optimal number of workers, because it's always going to hit that marginal productivity of labor curve on that portion where it starts to diminish. Okay. Questions on this idea before we keep moving? Sometimes I'll get pushback here, but we'll revisit it. If you are thinking about it, maybe I'll touch on that here in a second. Okay? So we've got this marginal productivity of labor curve, right? We know that it might increase initially because of specialization, but over time it'll start to diminish. Okay? We're now going to talk about not our marginal returns to labor, but the average product of labor. So not the marginal product, but the average product. So as I hire more workers, right? If I do have gains from specialization, as I hire more workers, what's happening to the average productivity of my workers? If I go from 1 to 2, I said, well, initially, like if I have one worker, their marginal product is simply the average. There's only one worker, right? But if I hire a second worker, if both of my workers are now more productive, what would happen to my average productivity of labor? It is going to be a little bit higher. And if I continue to hire workers on that gains from specialization, my average productivity of labor will be increasing. Now, as soon as I start to hire a worker, let's say the average product or the average output I'm getting per worker I hire is 10. If I then hire a worker who's only adding 8 units, what's going to be true about my new average? If I add a number that's lower than my new average has to be lower, right? So as soon as I start to get on that diminishing portion of my returns to labors curve, my new average is going to start to be lower, right? So I can think about, if I'm calculating the average, as simply this quantity over labor. It's not the marginal product, it's just the average. So what's my total output over the total number of workers I'm hiring? Anytime my marginal productivity of labor is above my old average, my new average will have to be higher. And anytime the marginal product of labor is below my old average, my new average would have to be a little bit lower, right? So if they're exactly the same, right? If my average is 50 and I add a worker who also adds 50, my new average would be 50, right? It wouldn't be changing at all. So you can kind of put this in table form, right? I have the same numbers that I had for the burrito example, or at least I think it looks like pretty similar, right? So I can calculate my marginal productivity of labor just to kind of prove that. How would I get my marginal product? It's the change in output divided by a change in my labor. So here, change in labor is 1. So anytime I look at the change in output, that should simply be my marginal productivity of labor. Now the average will be my total output divided by the total number of workers. So for this first one, it would be 800 over 1. Now for the second worker, it would be 1800 over 2. So notice, anytime my marginal productivity of labor is above my old average, what's happening to my new average? It is now higher. As soon as my marginal productivity of labor is below my old average, what's happening to my new average? It's a little bit lower, right? So you can prove this concept to yourself with actual numbers. This is the way averages work, right? If I add a number that's above my old average, my new average has to be higher. So a nice visualization of this is going to be something like this, okay? So I can kind of draw this out for you. Sometimes it'll help to kind of see it built as opposed to just see like a graph thrown at you, right? But if I've got the number of workers or my quantity of labor, when I've got my marginal productivity of labor curve, initially where I'm seeing this gains from specialization, right? Well, oh, what do I want here? Now I've mixed my colors up. Here we go. So we'll have our marginal productivity of labor curve, right? Let's start it a little bit lower so we can kind of see this, all right? Initially, my average is going to be the exact same as my marginal product because I'm just hiring one worker, right? Now, as I hire more, as long as the marginal productivity of labor is above my old average, my new average has to be a little bit higher. Now, as soon as that marginal productivity of labor is below my old average, my new average has to be a little bit lower. Okay? So the average product of labor will always cross my marginal productivity of labor curve on some portion where I've got diminishing returns to labor. Right? This will always be what it looks like, right? This is just once again, it's a function of the way that averages work, okay? Any questions on this before we keep moving here? Okay. And if it helps, it gets kind of weird to think about when I'm hiring one worker. So if you're drawing this out for yourself to kind of remember this relationship, if you don't want to draw them starting at the same point, that won't have any change in what we're going to end up talking about. So if you want to think about always starting with the average productivity, like quite a bit lower, just to kind of help you think about that relationship, that's fine, right? In theory, technically, they start at the same point at that first worker, but we don't have to use that for what we're kind of where we're going, right? So if it's easier to think about a visualization of it like this, then by all means, this is how I would kind of think about it. Okay? All right. Where are we at on time? Okay, so we got 20 minutes left. Let me see. We might do this now or not. I kind of forget exactly what's on this. So let me check to see where we're at. All right, so we've talked about this, we've talked about this. Okay. Well, we'll hold off on this for a second. If I can get this to be, there we go. All right. So we won't access it yet. I'll publish it. I've got one more thing that I want to go through before we start to talk about this, okay? So we've now got this marginal productivity of labor curve we've talked about, right? What we then ultimately have to factor in, when I was showing you the optimal number of workers, we also needed to know something about how much are those workers going to cost us, right? So let's say I have this example and I've got the costs now. So I'm not thinking about the benefit to the company, how much output they're getting from hiring these workers. I start to think about what are my total costs when I hire these workers, right? So maybe I have to pay $1,000 for the rental space of wherever I've got my business, and each worker, the kind of going rate, and like I said, maybe this is per month, is $2,000. Okay? So I can start to think about, I've got these different number of workers I can hire, and I've got the resulting output. Okay? What would be kind of the cost of the building at every output level? It doesn't matter how much I produce, how much is my rent going to be in this example? $1,000. So to fill in the cost of the building, it's always the same. So if I think about kind of these costs where I'm not changing anything, these are going to be fixed factors of production or things that we can't change in the short run. I can't move to a completely new location overnight. These are going to be things that maybe I can change in the long run. But for right now, if it doesn't depend on my production decision, kind of what is my cost of the building here? It's a sunk cost, right? I got to pay $1,000 no matter if I hire 1 worker, 2 workers, 3 workers, or 4, right? Now, if I hire my workers, what should be happening to my cost of labor? If every worker costs me $2,000, as I hire more of them, my costs are going to go up, right? So here I can think about my cost of labor. If I have to pay each worker $2,000, I would just calculate that by the number of workers I'm hiring times the going wage. To get my total cost, I would simply add those two together, right? So we'll start differentiating between things that we call fixed costs. These are like sunk costs. They don't change with my decision making. We also have variable costs. Those are changing, right? As I hire more workers or I want to produce more, I'm going to have to pay more money to hire those workers. But then the sum of those two, the sum of my fixed and my variable costs, will be just my total costs, okay? So I can kind of think about here, what's the total cost of my production, right? Well, if I wanted to produce these, if I don't worry about the workers for a second, well, I now know, because I knew the number of workers I was hiring and the wage rate and how much I was spending on the building, all I'm doing on this slide is grabbing that total quantity, the number of burritos I want to produce, and what the total cost that would be required to produce that many. So that's what I'm looking at here. I'm just going to plot that on a graph, right? So as I want to produce a higher quantity, what's going to happen to my total cost? Well, if I've got to hire more workers, my total costs are going to have to go up, right? But now, if the number of burritos I'm getting or my additional output is going down, right? If I'm at this portion of my marginal productive labor where I've got diminishing returns to labor, as I hire each worker, what's my total change in my cost? Each worker was costing me $2,000. Marginal cost would be the change in my total cost divided by what? A change in, so if I'm looking at what's on my x-axis here, it's the change in output. So my marginal cost is the change in my total cost divided by a change in output. Well, if my cost is always changing by the same amount, but if I've got diminishing returns to labor, what's happening to the change in my quantity from each worker I'm hiring? It's getting smaller and smaller, right? So if my denominator is getting smaller, that marginal cost is going up. Or my total cost curve is increasing at what type of a rate? It's getting steeper, so it's increasing at an increasing rate. The exact inverse of what we talked about with our production function. Okay? So when you kind of think about calculating these marginal costs, it'll be the change in my total cost divided by a change in whatever the output I was getting from hiring that additional worker was. Right? Now, the change in the total cost for us here, when it's labor, is generally the same amount. Right? Each worker was costing me like $2,000. But because I'm hiring less and less effective workers, even though the change in my total cost was the same, that change in the number of workers I needed, right, or the change in the total output that was kind of giving me that additional cost of hiring one more worker, that number was getting smaller and smaller. My marginal costs were going up. Okay? So I could calculate my marginal cost by simply looking at what's the change in my total cost and dividing it by a change in the number of units I want. So initially, this is what, 2,000 over 1,000? Well, then I said if each worker is going to cost me $2,000, every single time the change in my total cost should be 2,000. But now hiring that second worker, I'm getting less burritos from them or less output. So the change in the cost is the same. The change in output is smaller. So my marginal cost is going to be a little bit higher. And then if I keep on hiring more workers, it's the same change in my total cost. Each worker costs me 2,000, but I'm getting fewer units of output from them because they're less and less effective workers. So if my denominator, that change in output, is smaller, my marginal cost is going to be even a little bit higher. And then so on and so forth. I could kind of reproduce these values simply using that marginal cost equation. Okay? So to make this connection, and then we'll kind of take a look at the quiz. We said if I'm thinking about the number of workers I'm hiring, and I've kind of got output here, right? Our marginal productivity of labor, maybe initially, we've got this gains from specialization, but eventually diminishing returns takes over, okay? So kind of a similar idea. When I graph out my marginal costs, I'm not actually putting my workers on the x-axis. What am I putting on my x-axis? Output. Remember, marginal cost was the change in total cost over a change in my output. So I'm thinking about kind of the output I want here. So instead of kind of this, like downward U-shaping marginal productivity labor curve, for my total cost, initially, when my workers are becoming more effective, what should be happening to my marginal costs? It would actually be going down, right? So every portion where I've got gains from specialization, what's happening to my marginal cost curve? My marginal costs are actually going down. Right? Now, what's happening every point past that? If I'm hiring less and less effective workers, every unit of output is going to cost me more, so my marginal costs start to increase. These are exact kind of inverses of each other, right? Our marginal productivity of labor curve, because I'm getting fewer units per worker and I'm paying my workers the same amount of money, that same hourly wage rate, my marginal costs are actually doing the exact opposite. Okay? So that's kind of that relationship. And that's why we focus on talking about gains from specialization versus the diminishing returns portion, because what do companies care about when they factor in how do I maximize my economic profits? I'm looking at marginal benefits or marginal revenue and my marginal costs. So they'll be using this marginal cost curve to make their production decisions ultimately. And we'll kind of get the bigger picture next class, but that's kind of where we're going. We're going to need those marginal costs. Okay. All right. So now we should be kind of ready to go here. And now I'm already forgetting what I set this to be. It's 12 point something. 12.28. Okay. So we've got 12.28. This quiz should be available under the quiz tab or kind of on that home page down here. So we'll kind of take a look at these questions, change the time so that it's due at the end of class, and we'll give ourselves a little bit of time just in case we run right to the end of class here. Okay. There we go. right? And then you don't want to know the answers ahead of time, so I'm going to hit this preview button. Okay? So if I'm thinking about these, hopefully the first two, we're going back a ways to what we talked about in class, but hopefully these are easy. So if I'm thinking about someone's got an office space and I own the office space, right? If the rent I can charge goes up by $500 a month. So let's think about, I've got this office space and I'm currently using it. Yeah. What did I say? Was it 12.28? Right? Yeah, so 12.28 should be that code. So if I can now charge $500 more, well, if I own the space, how much am I actually paying for it? If I own it, let's assume we don't have a loan out on it, I'm paying nothing, right? I own the space. So if I can now rent it for $500 more, what's happened to my explicit costs? Have they changed at all? No. But if I could be renting that space out to somebody else for an additional $500, what's happened to my implicit costs? My implicit costs are now higher. So my accounting profits only taking into consideration my explicit costs. So what's happened to my accounting profits? Well, my explicit cost didn't change, so nothing. But because my implicit costs were higher, what's going to happen to my economic profits? Well, if my economic profits were total revenues minus both my explicit and implicit costs, I'm going to be subtracting a larger value now. So my economic profits will be a little bit lower, right? The fact that I'm not renting out this space is now costing me more in that I'm foregoing making even more money than I could have been previously, right? So my accounting profits shouldn't change if I own the space, even though the rent I could charge is higher. But my economic profits will actually go down, right? So no change to our accounting profits because there was no change to our explicit costs, and that's all they factored in. However, our economic profits factored in our implicit and explicit costs. Because we can now rent the space for more, we're foregoing more. Our implicit costs are higher. Our economic profits would actually be decreasing. Okay. Any questions on that idea? And if it helps for you to kind of write out what your accounting and economic profits are. If my accounting profits are simply my total revenues minus my explicit costs, if these haven't changed, my accounting profits haven't changed. But my economic profits, that was my total revenue minus my explicit and my implicit costs. Well, these weren't changing. But we said if I could rent the space out for more money, my implicit costs were going up. If I subtract a larger value, my economic profits would actually be going down. Any questions on this idea before we keep moving? So now the second problem is the exact same setup in numbers, but let's think about if I don't own that space and I'm renting it. Well, if I'm renting it, what has happened to my implicit costs? Well, implicit costs are what I'm foregoing. Am I foregoing anything if I don't own the space? No, so we would have like no change in my implicit costs. But if I'm renting a space and rent goes up by 500, that's something I said you can think of explicit costs or something I'm actually handing money over for. So what's happening to my explicit costs if I'm renting the space and rent now goes up by 500? My explicit costs would be going up. So what's going to happen to both my accounting and economic profits? I'm subtracting a larger value. So both of them, would be going down now, right? So whether or not I own the space or not kind of changes my implicit and explicit costs. So if it's an explicit cost, it's going to impact both economic and accounting profits because that's factored into both. But in that first problem where I had something that was only changing the implicit cost, that's only going to impact my economic profits. Okay? So for that second one, when rent goes up by 500, that should lower both my accounting and my economic profits. Okay? So there we're kind of highlighting that difference between explicit and implicit costs. Okay? Any questions on that idea before we keep moving? Okay. So now let's think about if I have workers that are costing me $500, right? What's the marginal product of that 200th unit here? So if I want to know the marginal, the marginal product of labor. Sorry, I should have added that term in there. We're going through it together. So I'll go and edit the quiz if you want to go back and review it. But the marginal product of labor of that 200th unit. Well, to get that 200th unit, I'm going to have to go from hiring what? 4 to 6 workers. So how do I find the marginal product of labor? It's the change in the output I'm getting divided by a change in the number of workers. So what was the change in my output when I went from 4 to 6 workers? I was going from 100 to 200, so the change there was 100. What's the change in the number of workers? So 100 over 2 would give me 50. So we should hopefully know that 50 is the right answer for the first part. Now, what's happening to the firm's marginal cost at that 200th unit? Right? So this gets a little bit tricky, but I could actually use something that we already talked about here. What was my marginal productivity of labor going from 0 to 4? So the change in output was 100, change in workers was 4, so my marginal productivity of labor would have been 25. When I went from 4 to 6, what was my marginal productivity of labor? We said it was 50. So what's happening to my marginal productivity of labor? It is increasing. We said as long as I have gains from specialization, what's happening to my marginal cost curve? It is, so as long as I have gains from specialization, as I hire more workers, every unit there, my cost should be going down. Right? So I can use that concept. I don't even actually have to calculate my marginal cost. As long as I know that when I have gains from specialization, which is identified by the fact that as I hired more workers, I'm getting a higher marginal productivity of labor, which we just discussed. I know that when the marginal productivity of labor is going up, my marginal cost must be going down, right? So there, we had that marginal productivity of labor is 50, which means my marginal cost at that unit must be decreasing, okay? So we can kind of use that concept, okay? Any questions on that idea? All right, so what we really did there was we said, when I hired those first 4 workers, my marginal productivity of labor that I was getting was 25. When I went to that 6th worker, we calculated the marginal productivity was 50. So I must be on that gains from specialization portion, which means I know that my marginal cost must be decreasing. Okay. Any questions on that idea before we keep moving? All right. So that 4th question, I think I'll hold off and kind of wait, and we'll start with this next class and kind of revisit this idea. But we really talked about this already, right? So if I wanted to know the marginal cost of these units, I'd have to know something about what the wage is, right? But as soon as I know what the wage is, I then know the change in my marginal cost, like if how much my costs are changing by. I also know how many units I'm changing. So to get my marginal cost, it was the change in my total cost, which will be whatever the wage rate was. In our earlier example, it was 2,000. We now have the change in output, which would be in our denominator. We could actually calculate marginal cost from this table as well. So don't worry about answering this 4th one. I'll kind of edit the quiz to just grade you out of the first 3. We'll kind of revisit this next class. We'll talk more about what a firm's cost structure looks like, how they make optimal production decisions, not just the number of workers. And then, like I said, probably at the end of class, I'll revisit some of that Module 8 material. Okay? All right. I will see you guys on Thursday.